Let's preview what to expect from that and get a view from the wider bond markets now with Georg Grodzki. He's head of credit research at Legal and General Investment Management. Georg, thank you so much for coming in. It seems that actually, despite all the efforts that the EU leaders are trying to put in to calm the markets, well, bond investors still aren't biting. They say it's still too dangerous, and actually we're seeing a lot of the auctions not having failed but not having done well.
Well, indeed, many uncertainties have been addressed, but not all of them. In the long term, it is still very unclear and debatable whether Greece will escape a restructuring, number one. Number two is Portugal so far is still denying that it needs a bailout. Many others disagree and want them to ask for help sooner rather than later. So that's another open question. And then you mentioned the Irish interest rate. But broadly speaking, we should not ignore the fact that compared to where we were 3 months ago, we have progressed. And I wouldn't be surprised if this week's auctions will actually go relatively well. As far as Spain is concerned, Spain clearly made efforts to improve the confidence in its country, in its economy, in its fiscal consolidation. There are still many challenges, many questions they have to face, but they're working hard. And the market, I think, is inclined to give them credit for that.
But will this week actually bring comfort to investors? We had the finance ministers meeting, and you really see this disparity between the European Central Bank and the finance ministers in saying how much this fund has to be versatile.
In some way, probably Europe is lucky because investors are distracted by other issues at the moment, and if there was more focus on the unresolved questions, probably the state of alarm or the sense of alarm would be higher. But compared to the other challenges in the world, probably investors at the moment are less concerned than they would be otherwise. And generally speaking, as I said, the increase in the size of the rescue fund, which is likely to be agreed at the end of March, as well as some increased flexibility with regard, for example, to primary bond market purchases, should at least help to improve confidence, even though comfort is a word which will not be mentioned for a long time.
No, but at least we have some kind of package. Georg, stay there, because we also want to talk about the disaster in Japan and how that's affecting credit markets. Now, the so-called catastrophe bonds may escape the quake relatively unscathed, outperforming stocks and commodities. These bonds are sold to help insurers cover their most extreme risks, such as an earthquake rocking Tokyo. But last week's quake struck about 240 miles northeast of the capital, and analysts say that will limit, of course, the payouts that investors will have to give to insurers. Still, investors are concerned that Japan's disaster along with the conflict in Libya will hurt the global economy, and that's pushing up borrowing costs for companies and in turn hurting new sales of corporate debt. So what impact, Georg, will this of course have on the view that you have for the world economy? We saw PIMCO last week say actually they're going to be very prudent even on treasuries. Catastrophe bonds actually getting away with it maybe a bit lighter than other bonds?
Bond markets are subject to conflicting forces at the moment. On the one hand, we have the rise in inflationary pressures, which normally would suggest at some points yields are going to go up and interest rates are going to go up. At the other end of the scale, we have an understandable flight to quality, given the unrest in North Africa and the Middle East, given, of course, the latest developments in Japan. Risk appetite should therefore shrink. That should raise the appeal of government bonds and therefore drive yields down. It's hard to gauge at the moment where the result will be.
And I guess the concern, of course, on Treasury is that there's so much Treasury held by Japan that if you see a lot of these funds being repatriated, then the Treasuries are going to be the first ones to be sold off.
Correct, but we still have QE in the US, and the understanding from the wording from the Fed is that they stand ready to prevent any major sell-off in treasuries if that was to be the case. There are also other voices saying that due to the flight to quality, which I mentioned before, and the decline in risk appetite, as a result of waning confidence in global growth, treasuries may find a bit elsewhere. Yes, the Japanese may sell, but others may seek safety in treasuries. So therefore, the net effect of these forces is unclear as of yet.
Georg, so what's your advice at the moment for investors? Is there anything that they should be buying? Maybe some emerging economies bonds that look more attractive than other ones?
Well, in a way, if you want to capitalize on the latest problems, and I'm afraid to do so. Obviously, capital goods manufacturers and any manufacturers of drilling equipment and construction equipment should benefit from what's what's happening at the moment. That's almost a bit of a cynical view. But broadly speaking, I think central banks will remain very watchful and will be very careful not to act too early. So therefore, at the moment, probably you're not badly off staying in bonds whilst all this is playing out, and wait until equity markets have found solid ground again, which seems to be the case at the moment, but the week isn't over yet.
Georg, thank you so much.